Here's the deal. Tariffs make Canadian exports more expensive, which means fewer American buyers, less demand for our products, and boom, the loonie starts to tank. And if the dollar drops, then everything we import gets more expensive. Groceries, gas, travel, you name it. Now, some people are saying the Canadian dollar isn't that bad compared to other global currencies like the euro, the Chinese or Japanese currencies. And technically, that's true. A lot of major economies are struggling against the USD right now. And I'm not sure if that'll be the case as these tariffs start to take hold. There's this chart in Bank of Canada's monetary policy report that shows depreciation against the US dollar was broad based and shows a bunch of different currencies. But here's the key difference. If you look at Europe or China or Japan, those countries all share land borders or are close by with more than one trading partner. So if their currencies all drop at the same time, they still have access to trade and supply chains within the region. Canada, not so much. Time for a geography lesson. For all these currency experts who were maybe wildfire or AI experts last week. I'm not a rocket surgeon, but I'm pretty sure if you look at a map, Canada only has one border, and it's with the US. That means if the US slaps tariffs on us, which they just did, we will feel it way more than Europe does or China does. People say just trade more with Europe, but it's not that simple. Shipping goods across the ocean is way more expensive and way more complicated. Plus, we don't have those supply chains, and it's a lot more expensive than just driving them across the border on a truck or a train. So what should you do? What should you expect? If you're holding US cash or real estate, you might be sitting pretty. Even though their economy is about to take a dive, the exchange rate might do you some favors. But if you're planning to take a trip to Florida or buying anything priced in USD, like if you were hoping to buy US real estate this year, which a lot of Canadians won't stop talking about, you might be feeling it. And you'll continue to feel it on imported inflation, which means anything we buy in USD could get more expensive as our currency drops relative to the USD. And now we have Canadian tariffs on US goods coming into Canada, which Trudeau announced on Sunday, February 2nd, the evening of February 1st. If we're not exporting as much to the US, there's probably a lot of potential surplus material in Canada, which could mean maybe costs go down. And if Canada claps back with this trade war, that could create a more inflationary environment on imported goods as we get this tax on our own goods, because I would call inflation a tax.
Okay, so are we getting to the part where you're going to make that big, bold prediction or predictions?
Yeah, I mean, I guess my thought would be you're going to see a lot of volatility in interest rates. Construction costs are more likely to come down than they are to go up because we create a lot of construction inputs. And from my perspective, this is my big prediction. Regardless of who wins the election, liberal or conservatives, don't be surprised if the Canadian government quietly starts walking back the foreign buyers ban. Why? Because if the economy starts struggling under these tariffs, they're going to look for ways to bring foreign direct investment back in to capitalize on the weak Canadian dollar relative to the USD. And one of the easiest ways to do that is open up Canadian real estate to shift overseas buyers into Canadian market again.
Ooh.
Now, yeah, I can totally see it happening. I've been talking about how we need a diverse economy for a long time on this show, and Donald Trump just kind of shot that one right in the foot.
Yeah.
So, yeah. Well, I mean, it doesn't help if we have a diverse economy if everything we're exporting is now tariffed. So I could see the government going really hard on housing. Anyway, you tell me about the tariff package they just announced, and we can speculate a little bit on the direction this is heading, because I've already spoken far too much for the entire episode.
Some great points. Let's look at the tariff package here. Some of the key points are 155. It's a $155 billion tariff package. Canada has announced a 25% tariff on the United States goods in response to the U.S. doing the same thing. First, $30 billion effective February 4th, and an additional $125 billion pending public comments. So astronomical numbers here. Now, what is this going to affect? Well, it'll affect products like initial tariffs. Well, things like orange juice. So if you're an orange juice with your bacon and eggs in the morning person, that will affect you. Peanut butter, wine, appliances, paper products, and then maybe future potential tariffs in that kind of second wave that we might be getting, affecting things like vehicles, steel, aluminum, agriculture. Now, How will this have an economic impact? Well, Dan, as you said, Canada is the U.S. largest trading partner with daily cross-border trade exceeding 2.5 billion. That is 2.5 billion a day across our massive border that we share with our biggest trading partner. And of course, millions of jobs both depend on this. And think about that downstream or upstream or that trickle down effect when something happens like this, right? So the government is establishing a remission process for affected businesses and workers with additional economic support programs available through Crown Corps and employment insurance. So they are likely going to have to print more money to throw at this. And then from a border security context, Canada has now emphasized that less than 1% of fentanyl and illegal crossings into the US come from Canada and have already committed 1.3 billion to a more comprehensive border plan. So that was one of the major issues that President Trump had was the fentanyl piece. Now, Dan, what could it? This sounds like we're gearing up for a trade war. What could
Yeah.
that mean?
Generally, I think a trade war means that we are now forced to think like defensive investors. We're entering into a risk environment. And, a trade war could mean, and it's too early to tell really what the balance of forces is going to end up. I think the way the market opens, looking at the Canadian dollar, the stock market, et cetera, on Monday, February 3rd, is going to be really the determining factor, to be honest with you. We might see decreasing interest rates in the short term. We might see increasing interest rates in the long term because this could become inflationary, right? If you just increase a 25% cost on all of our inputs, it might be short term volatility in interest rates and long term unpredictability in interest rates. You can see reduced consumer spending, probably declining rents, job losses, reduced lending from banks, right? Capital contraction, probably declining property values as a result of that.
Yeah, all sounds pretty bearish to me. And now, if you're an existing investor, some of the questions you should probably be asking yourself to prepare for this potential scenario is: do all of your tenants have stable jobs? Would any of them need financial assistance? Are there certain properties that have maybe been late on rent before that you can see that being a bit more of a problem now? How much vacancy or non-payments of rent can your portfolio sustain until you start to go into negative cash flow? Do you personally have a stable job, and are the defensive moves that you need to make to maybe top up those rainy day or emergency funds? Now, assuming we're pretty much guaranteed a true recession at this point, are there any changes you'd make to your portfolio? Do you want to get rid of that one property that's a bit of an anchor, quickly go and repair that thing that you've been meaning to do, or really figure out any way to stabilize your existing assets? Remember, we always talk about before going and increasing, you really want to make sure that your existing assets are performing to their highest and best use.
And if you're in acquisition mode, thinking about making an investment, then that's kind of what the rest of the episode is going to be about. I think our goals change a little bit when trying to select a location here. And honestly, I feel like all of the optimism that we've had towards a diversifying economy kind of gets thrown out the window here, where, it's like, can we really benefit from a more diverse economy, resources, Canadian production, and goods production, if all of those goods just got the demand for them just got reduced? You might want to think about what areas geographically or what industries sectorally have the most resilience against this trade war and these economic impacts. And we're going to talk all about that today. So, and before we do that, I want to start off with kind of the last piece that mentioned in that article from Canada.ca website from the government. Ottawa's planning pandemic level relief for workers, businesses if Trump opposes tariffs, sources say. Yeah, so the federal government is planning a stimulus package to help businesses if Canadians in light of these tariffs. And they mentioned that in the Canada.ca thing, but also David Eby from British Columbia and Doug Ford from Ontario both promised the same thing.
Yeah, I mean that's a tough one, Dan. I mean, you and I are both small business owners, have been for quite some time. A lot of the people we deal with are small to medium sized business owners. You know, occasionally we deal with the old large business owner, but this is going to impact those business owners and entrepreneurs probably more so than most. And you know, I'm all for support of the small to medium business sector in Canada. I truly believe in it. I think it's probably a piece of the backbone of the economy. But at the same time, COVID level relief, like, did we already forget what that just resulted in? So, I mean, yeah, to continue, right? The pandemic level government response, that would include employment insurance benefits and business assistant programs. However, that might all be delayed because we don't have a enacted government right now. We are still prorogued. Is that it? Prorogued?
Yeah.
Yeah. Okay.
Yeah.
Good. Yeah. So, and look, I mean, that's all going to affect the Canadian dollar as well, right? For all you forex traders that listen to us, currency depreciation could partially offset those tariff effects, with a weak Canadian dollar making the actual impact of those high 25% tariffs a little less severe for the U.S. buyers than it appears on paper, because our dollar is so weak right now. And man, that dollar, Dan, I know you've been following it a lot closer than most, but that dollar has been on a bit of a roller coaster ride for the last little while.
Yeah, it's interesting because we had said a long time ago, before tariffs were even a question or a twinkle in Donald Trump's eye, that the Canadian dollar would really be the victim of a lot of, like, basically what was happening as Canada had to kind of grind into a recession and the US was looking stronger economically. I think the Canadian dollar is still going to fall victim, but you know, again, I was calling for recession. I was calling for a weaker Canadian dollar. I will not say that I predicted that this was going to be what caused it.
Yeah.
By the way,
Yeah.
like, this is all something that I never would have seen coming.
These unprecedented times are just still with us. Hey,
yeah.
It's wild.
Isn't there's some I think it's like a Chinese proverb that says, like, well, it's actually more of an insult, but it sounds like you're giving somebody a compliment, where you say, like,
give it to me.
May you live in interesting times, right? And
you just insulted basically the entire world by saying that right now.
Yeah,
but
that's where we're at.
What a time to be alive. Okay, let's get back on track here, Dan. Start to talk to me about how this will affect real estate from a building standpoint, a transaction standpoint, a market specific like regional market standpoint. What's your take?